நினைக்கிறேன். ஸோ அந்த விதத்துல வந்து ஸோ அனைவரும் பயன்பெறுவாங்க, கம்யூனிட்டி அனைவரும். ஸோ வித் தட் ஐ வில் ஸ்டார்ட் இன் இங்கிலீஷ். And Prasanna is our long-term supporter in San Francisco Bay Area. And also he is our sponsor for FeTNA for last year convention. He was kind enough to contribute a lot for us for our convention, for the successful convention. And we are hoping he will continue to support this year too. He is doing the tax planning and services all over North America, especially mainly in US, across the US. He does it. And he does it in various like individual level and corporate level and many other levels. So, and maybe I will give it to you, Prasanna. So if you can introduce yourself and if you can share your contact details and everything, what are all the services you are offering, and maybe if you can present to us, it would be good. And Roshan is from our FeTNA board, and Roshan is going to moderate this session. And any questions you have it, எல்லாத்தையுமே நீங்க chatல post பண்ணுங்க. At the end of his presentation, we can ask one by one questions, anything related to, right? So in corporate filing or tax filing or like, right? So other, all other things, like when he is sharing the presentation, if you have any questions, you can always post it in the chat and that can be shared. And he will be answering as much as we can. And Pradeep, and we are live, Facebook and YouTube.
Yeah, we are live on that and we are also recording in the cloud.
Okay. Thank you. Prasanna, it's all yours. And Roshan and myself will be in the thing, like if you have anything to assist, right? And Pradeep is that for us too. I forgot to inform Pradeep. Pradeep is our one of the core committee, like from FeTNA committee. He takes care of all the audio, video, and presentations and, hosting all these events, right? So FeTNA. So thank you, Pradeep, for joining on time and helping us.
Thank
Prasanna,
you,
it's all
Karthik.
yours.
Thanks for the intro, and thank you so much, Pradeep and Karthik and FeTNA team for organizing this event. Good evening, everyone. My name is Prasanna Kumar. I've been running Finlo Tax is the company I am running, and I've been in the tax industry for more than 15 years now. And I've worked with a corporate company. I was operating a franchise business. We are a team of tax professional in this company. I'm an enrolled agent, enrolled to practice with IRS for any representation, for any notices, audits, or solving any tax issues with the IRS. So we are a team of tax professional. We are trying to help minimize the taxes for W-2 professionals if you are a business owner. And in addition to that, we can also help you with filing services, maybe foreign compliance services. And if you have any issues in the previous year, if you have to file any corrections or amendment, or you're looking to start a business, we can help you with company incorporation, accounting, bookkeeping, and the payroll services for a small business. Now, this session today, our primary focus, we are right now at the tax filing time. So this session is primarily to give you some information on how you can minimize your taxes. For 2025, there are a couple of opportunities. You may be able to still take the deduction and minimize your taxes. And also, planning is always a good idea to start beginning of the year, because the planning has to happen before December 31st. It may be a good idea for you to plan your taxes ahead. In some cases, we always suggest you plan for next 2 to 3 years right now, because there are some opportunities by diversifying your income into various categories. Because if you are a W-2 income earner, then your options are very limited on how you minimize your taxes. There could be some options where with diversifying your income into a stocks or maybe a real estate, or you want to start your own business. That's how you can effectively minimize your taxes. So I'll give you brief information on how you can minimize your taxes. Before we get into that, as a disclaimer, this is for educational purpose only, not a legal advice or a tax advice, because some of the deductions and the examples what we present today is subject to IRS, some of the additional IRS guidelines, which we may not be discussing today. But if you need a professional consultation or a service, please do contact our office, maybe consult with your accountant. They can make sure that, they can advise you more whether you can or you are eligible to take any of these deductions. Now, We are getting very close to
Prasanna,
the
before
LLC.
we go further, sorry to interrupt.
Yeah.
Do we have any phone number or something that you will put it here, like office number that they can reach out if they want to talk? Or you
I'll
will
give a
tell?
contact at the end. They
Okay.
can visit our website finlotax.com, where you can directly submit your request and schedule a 20-minute meet
Okay.
consultation with us. Or you can contact us over the phone. So I'll give you my contact information also at the end. As we discuss, if you have any questions, please put it in the chat box. We will be taking those questions at the end of this session. And as you know, the tax filing due date for 2025 is April 15th. And if you have any foreign financial accounts, you may need to file FBAR and FATCA, which is due on April 15th. And then if you have gifted a money of more than 19,000, then you may need to file a gift tax return, which is also due on April 15th. These three are a separate filing. So you have to make sure, you're compliant with these services or these filings. And then if you are a business owner, then for LLC and S corporations, the due date is March 15th. For C corporations, the due date is April 15th. So for LLC and S corporation, the due date is tomorrow, which is March 16th, because today is Sunday. If you have not completed your filing, we suggest you to contact your consultant and make sure that you take an extension. That will give you 6 months additional time to file your tax return. Otherwise, you may end up paying late filing penalties. And if you own a non-profit organization, if you are running that, then the due date is May 15th. And if you are a business owner and you are providing any employee benefit plans like a 401k for your employees, you may need to file a form 5500, which is due on July 31st. Now, our today's agenda is basically to understand more about how the new tax bill, the one big beautiful, will impact as an individual filer business owner, and how you can minimize tax as an individual filer. And then also, if you are capital gains or you are more into real estate, how you can minimize your taxes. Also, how you can minimize tax as a business owner. So we'll start with the individual, the one big beautiful bill. So the some of the key changes for as an individual filer for 2025 includes the standard deduction has been increased to 31,500 if you're filing jointly. Also, the SALT tax deduction, which is the deduction for your state taxes, and the local taxes, which is the property taxes you pay. So the previously the deduction was limited to around 10,000. With a new tax bill, you can deduct up to 40,000 if your family income, if you're filing jointly and your income is less than half a million, then you can take deduction up to 40,000. And then also, if you have purchased a new vehicle, you can take deduction for the interest you pay on the loan, which is up to 10,000 if your income is less than 200,000. If you have a new baby born in 2025, you can also enroll for a Trump account, where the government will give a seed funding of 1,000, and then you can contribute from your pocket around 5,000. So that means, you don't get any tax benefit for the contribution. This is similar to Roth IRA of a Section 529 education plan, where your contribution is non-deductible, but the growth can be tax-free. But if your employer provides this as a group plan, up to 2,500 you contribute through your employer plan, so can be a pre-tax. So this is one of the idea where you can minimize your taxes. Also, we were expecting the tax rates will go up, but with a new tax bill, they have retained the old tax cuts and jobs act tax rates. That means, most of the people who are earning less than 3 to 400,000, and probably they may be saving in the range of 5 to 7,000 because of the lowest tax brackets what we have right now. We were expecting it would grow, it will go up, but they have retained the same existing tax rates. If you have purchased the electric vehicle, then you can take electric vehicle credit if you have purchased before September 30th. That's one of the changes with the new tax bill. If you are a business owner, there are major changes. One of them includes the bonus depreciation, especially when you buy an equipment or an asset for business. In general, you can take a depreciation over a period of life of the asset, maybe for 5-year period or a 15-year period. Earlier, the bonus depreciation for most of the assets was around 40 to 60%. Now, with a new tax bill, the bonus depreciation has been restored to 100%. That means if you buy a vehicle which is the purchase with a purchase price of maybe 100,000, you can take full amount as a deduction in the same year, assuming you are using that asset for 100% for business purposes. And then also you can take qualified business income deduction or an exemption, depending on your profits in the company and the total income when you file jointly. So let's say your profit in the company is around 100,000, you can exclude or take a deduction up to 20,000. That means you don't pay tax, and 20,000 you pay tax on the 80,000. So that has also been made permanent right now. And then also if you have a startup where you're spending money on research and development, you can, earlier there was a credit and then also deduction, but not the 100% deduction in the same year. Now with a new tax bill, you can take a tax credit, which is in the range of around 20% for the R&D expenses. Also take it as a deduction. So there is a double benefit on the R&D expenses, what you spend. So these are some of the major changes. There are so many other changes as part of the bill, which may not have much impact. So, but these are most important one I thought I should share with you. Now, moving on to the tax saving for the individuals, if you are an individual filer, there are some of the ways you can minimize your taxes, which includes the 401k contribution around 24,000. Now, if your employer has a after tax 401k or the employer matching contribution, employee side of the contribution, altogether you can contribute up to around 72,000 in a year. If you don't have a 401k, you can do a traditional IRA contribution, which is around 7,500. The due date for 2025 filing is April 15th. If you have not filed your tax return yet, if you qualify for a traditional IRA contribution, this is one of the way you can minimize your taxes. You can also do a FSA contribution for health and dependent care purposes, where in general, if you have child care expenses, you can pay directly from your pocket and take a credit. So the credit is limited to around 600 to 1,000 approximately. Uh, but if you are participating in the employer sponsored plan, now you can, starting 2026, you can contribute up to 7,500 to a dependent care FSA plan. That means your tax saving, if you are at an income tax bracket of 35%, your tax saving is much higher. Maybe I would say it's in the range of 1,500 to 2,000 versus what you get tax credit when you take directly on your tax return. So I would suggest you to visit your employer sponsored plan. If you're paying from your pocket directly, I would suggest you to enroll in the company sponsored plan. And then also if your company has an HSA plan, and generally people who are on high deductible health plan, you can contribute to an HSA. This is for medical purpose. Most people, they want to have at least 100 to 200,000 accumulated in the HSA for a long-term care or any other purposes in the future. So I would suggest you also contribute to an HSA account, which will help you minimize your taxes now. Also, your income or the growth can be tax free, assuming you use it for a qualified medical expenses. So, and the due date for HSA contribution, if you're not participated through employer sponsored plan, you can set it up outside of the employer directly with any financial institution. You can contribute up to 8,700. And then also you can take deduction if you own a house. You can take deduction for your mortgage, property taxes you pay, and the state taxes you paid. And then also you can take deduction for your donations, which is cash donation, maybe donations in the temple. And you can take deduction for any assets you are donated, like goodwill donations you can take. These are some of the pre-tax deduction where you can minimize your taxes. In addition to that, if you have invested in any alternative investments like a partnership or any business where you are an active partner, most of the businesses, because of the first year, there could be losses or because of the assets they buy. And IRS has a provision that gives bonus depreciation. So there could be a loss or a negative K1. That is one of the way you can minimize your taxes. So maybe you should explore that opportunity if you are planning to invest in any partnerships or businesses. Now, in addition to the pre-tax contribution or a deduction, you can also explore. These are some of the ways you can minimize your taxes and the growth long term. Most people, they choose to invest in Roth IRA because the growth can be tax free, and then you are also not subject to required minimum distribution. So, but to qualify for a Roth IRA, in general, your income must be less than 200,000 if you're filing jointly. And depending on your financial, retirement contribution through previous employer and how much money you have in the traditional IRA account, you may be able to still do a backdoor IRA. So I would suggest you to consult with your accountant and see if backdoor Roth or a regular Roth IRA contribution is beneficial in your case. Then also you can do a mega backdoor, which is through employer. If your employer has an after tax 401k, you can do mega backdoor. That can be so the employee, employer, and the after tax 401k together, you can do up to 72,000. So I would suggest you to visit your paycheck, because when we file the tax return, most people, they have not maximized the retirement contribution. So this is the time, because of the change in the contribution amounts for 2026, it is around 24,500. I would suggest you to revisit your paycheck and the 401k deductions to increase your contribution amount to maximize the overall deduction and minimize your tax. Then also you can also contribute to a Section 529 educational saving plan, where some of the states, they give a deduction for this 529 contribution, and you can also, your income or the earnings also can be tax free, assuming you use it for a qualified educational purposes. And then you can also invest in T-bills or a treasury bond or a municipal bond, where your interest income can be tax free. That these are some of the ways where you can minimize your tax as a W2 income earner or a professional. Now, if you have other income such as capital gain, if you are more into stocks and you're expecting capital gain, there are some of the ways you can minimize your taxes, which is the most popular one is tax loss harvesting, depending on the portfolio. If you have a capital gain, generally tax loss harvesting is done at the end of the year. If you have a capital gain, so what you do is you visit your portfolio to see any loss making or stocks which are under losses, you sell the stock by end of the year, and so that can be used against your profits or the capital gain, and so that overall you minimize your taxes, and then you can reinvest or buy a similar stock or a same stock after 30 days to avoid your was sale. There is something called was sale, where you buy a same stock within 30 days. IRS will not allow the tax deduction for the losses. So you may need to wait for 30 days if you want to buy a same stock, or you can reinvest in any other stock which is in the same industry. So that's one other way where you can minimize your taxes. And then also there is something called direct indexation. This is a very popular strategy for people who are expecting huge capital gain, maybe more than 500,000 or more than 1 million, or you have concentrated stock where you want to exit or diversify your investment into different portfolio. Direct indexation is one of the great opportunity where you can, your financial expert or a financial advisor can reinvest your money and help you generate some losses. This is a complex strategy. You will have to work with your expert financial advisor to see how they can help you create losses and take losses against your capital gain when you have a huge capital gain by selling a concentrated stock. And then also you can, after you sell a stock, there is an opportunity where you can reinvest within 6 months period into a qualified opportunity zone property or a fund. These are government identified projects. You can be, you will be one of the investor as a partner. You get a K1 on the investment in general. Or you can also invest in a startup which is started in the QOZ identified areas where you can also buy a stock. So any reinvestment into these properties or a stock, you can defer your tax on the capital gain. So that's one other way where you can minimize tax. Also, IRS has a provision, if you retain that investment for more than 10 years, probably you will be able to the future earnings from the date of your investment into QOZ can be tax free if your holding period is more than 10 years. And then also, if you're a day trader where you have spent more than 750 hours in trading activity, depending on the volume, then it is considered as a trading business. You may be able to take trading expenses. The trading expenses includes, in some cases, you may have a margin interest, you may have some miscellaneous costs, which you may not be able to take it directly if you're reporting as an investor. Also, you may have expenses like maybe computer used or a telephone used, your internet expenses, maybe some portion of your house expenses if you have a dedicated office space for your trading purposes, any subscriptions you have, any licenses you take, any educational expenses you spend for trading purposes. You can take all these deduction in general. If you are able to take around 20 to 25,000 deduction for your trading cost, your tax saving, depending on your tax bracket, if you are at 3 to 400,000 of income, your tax saving can be more than 6 to 7,000 easily. Then also you can, if you are charitable inclined, then if you want to, there are few options where you can minimize your tax by donating the appreciated stock, which is called as a donor advised fund. This is a charity account you create with any financial institution where you transfer your asset, but you don't do charity today, but you will do a charitable activity over a period of next 5 years or 10 years. This is generally for people who are at a higher tax bracket today because they have received huge stock option, or maybe they have bonuses or any other income received, unexpected income, and you are at a higher tax bracket. So what you do is you put aside some money for charitable purposes and take deduction today, but you do a charitable activity over a period of next 5 to 10 years. And by doing that, we suggest that you can contribute your the tax paid cash, or maybe we suggest that you transfer your appreciated stock within the donor advised fund. You can have a brokerage account and transfer your appreciated stock. So that way you can take exemption, meaning the capital gains can be exempt as you're donating. And then also you can take the charitable deduction on your personal tax return. So there are two savings in this case. If your charitable activity or contribution is more than 100,000, it may be a good idea to create your own non-profit foundation, which is a family foundation. Only downside with having your own foundation is there is a cost involved in setting up and then the maintenance or the renewals. And it makes sense if your contribution is more than 100,000. But the advantage is you have more control on what kind of charitable activity you do with the private foundation. Whereas with a donor advised fund, the money has to go to only 501(c)(3) approved public foundations within the US. So you cannot do a direct charity, or you cannot do a contribution outside of the US. So based on your amount of contribution, and maybe you should work with your expert accountant to see what is beneficial based on your objectives. Now, if you see the simulation, if an individual is earning around 600,000 in income, with a W2 income of 400,000, rental income of 50,000, and the stock gain or a capital gain of 250,000. Now, assuming they reinvest around 50,000 into donor advised fund and also take tax loss harvesting deduction of 50,000 and reinvest in around 100,000 into qualified opportunity zone fund, then we are looking at reducing income from 600,000 to 400,000. That means your tax saving is around 50,000. Now, if you are more into real estate, there is very good opportunity with a new tax bill if you qualify for an active status. In general, if you have a rental income or a investment property, you may have a rental income. So basically you can offset your rental income by taking deductions, the rental deductions, which includes the mortgage interest, property taxes, your maintenance, repairs, and you can also take a depreciation for your building over a period of 27.5 years. And then you can take your insurance expenses. So by taking all the deduction, you may have a positive, some profits in the rental activity, or there could be a loss. If there is a profit, it is subject to tax based on your tax bracket. So you report on 1040. But if you have a loss in general, if your family income is more than 150,000, you cannot take that loss against your W2 income, because the rental real estate income is considered as a passive losses. So the passive losses are not allowed against your active income, which is W2 income. But if you have any passive profits, maybe investment in any other companies as a passive investor, or you have other rental properties where there is a profit, you can take that loss against that passive profits. So, but there is something called real estate professional status. In some cases, depending on how much time you have spent, and maybe if you have spent more than 750 hours and more than 50% of your working time, assuming one of these spouse is not working, and you are directly managing the properties, maybe you have more than 3 to 4 units or 3 to 4 properties, and you are spending good amount of time in taking care of the repairs, maintenance, maybe finding a new property, buying and selling, all kinds of real estate activities, then you may qualify for an active status. We also call it as a real estate professional status. Now, if you qualify for real estate professional status, or you do a short-term rental, by default, you may qualify for an active status by if you have spent more than 100 hours. So if you qualify for any of these two, then it becomes an active or active losses that can be taken against your W-2 income. Now, the tax planning strategy is with a new tax bill, which is one big beautiful bill, because there is the bonus depreciation right now is 100%. Now, for a real estate property, or bonus depreciation deduction in the first year can be in the range of, depending on the building value. If your building value is 1 million, your deduction in the first year can be more than 200,000. If the building value is, around 500,000, then your deduction can be in the range of 100 to 150K, depending on, the structure of the building and the components within the building. An expert company has to analyze and come up with an asset classification and give you an information like within the building what can be taken as a bonus depreciation. So assuming your deduction in the first year is around 150,000, which can be taken against your W-2 income. So that is a huge tax saving if you're more into real estate and qualify for an active status. Now, you can also buy real estate using self-directed IRA, which is using your retirement money or a 401k money. We call it as self-directed IRA or STIRA. Then other advantage with the real estate is when you sell a property, buy another one using 1031 exchange, you can defer your taxes. And you can also set up, we advise, if you are directly managing the properties, no property management company which is managing your assets, we advise you to basically set up a property management LLC and not take any tenant contracts in your name, just to protect yourself from any claim or damages directly against you. So this LLC will help you protect that, so you don't sign any contracts individually. And also there are some planning opportunity by setting up this property management LLC, assuming you are actively taking care of the real estate activity and you have your family members supporting you with that, assuming you are running some salary or a payroll for the people or a family member who is helping you in this activity, that can be taken as a deduction. Now, if they don't have any other income, generally up to 15 to 16,000 of income for them, that is exempt from taxes. So, and you may be able to also deduct some of the expenses which is not allowed directly as a rental real estate activity. So the property management LLC is one of the planning opportunity for you to minimize tax, also protect yourself from any liabilities. Now, for asset protection purpose, we also suggest you to create an entity for each LLC separately, so that any claim against one property is limited to that LLC. So your other assets are protected. This is more on the asset protection, not on the tax saving perspective. But I would suggest you to work with if you have multiple assets, maybe you should work with your asset planning attorney. Make sure that you set up you have a right structure to protect yourself from any claims or any damages. Now, if you see the simulation, if somebody is earning around 500,000 in income, with a W-2 income of 300,000, rental income of 150K, and the capital gains of 50,000, assuming they take a cost segregation deduction or a depreciation, bonus depreciation of 250,000, and then also pay salaries of around 20,000 to family member, and so that means you are reducing your income from 500,000 to 230K. That means your tax saving, it could be approximately around 95,000. So that's a huge tax saving. If you have any questions, please post it in the chat box. We will be taking at the end of this session. These are some of the deduction as a business owner. Now, as an individual, as we discussed, the options are very limited and your tax saving is not much. But as a business owner, there are plenty of opportunities for you to take a legitimate tax deduction, maybe maximize your retirement contribution, take other deductions, which will help you minimize your tax, which I'm going to give you more information on that. So one of them is contribution to a solo 401k or the retirement plan. In general, if you are an employee or working for a company, then your contribution, your 401k contribution is limited to around 24,000 as an employee side. as a pre-tax contribution, but as a business owner, you can do a pre-tax contribution up to 72,000 depending on how much revenue you have in the company and how much salary you are taking. So the savings would be much higher as you are contributing 72,000. Alternatively, you can do a SEPA IRA contribution similar to solo 401k that can go up to 72,000. Also, you can also do a pension plan or a defined benefit plan contribution. The maximum you can contribute is around 285,000 per year. It's based on, when was the company started, how many years of your service and your age and multiple factors. This has to be, you need to work with a third party administrator or your financial guy who can confirm how much is the maximum you can contribute. But in general, it can go up to 285,000. Now, if you purchase a vehicle or any other asset for your business, for example, if you have a restaurant kind of business, because the restaurant will have many machineries and any other equipment. So, or you have a business where you buy a new vehicle for business purpose, including your tech businesses, you will be able to take 100% depreciation. Generally, to take 100% bonus depreciation for vehicle, it has to be an SUV of more than 6,000 pounds in gross vehicle weight. Then you can take 100% depreciation for your vehicle. Now there are these are few more deductions which can help you minimize tax as a business owner, which is basically employing your family member, assuming they're working for your business, and any salary for them, including your children, if they are recruited for maybe administrative activity or they are working as an intern. Now any salary for them up to 15,000 or 16,000, because of the standard deduction, there is no tax. Up to 40,000, they're still at a lower tax bracket, maybe around 10 to 12 percentage. Whereas if you are earning around 400 to 500,000 net, probably you may be at a tax bracket of 35 percentage, 35 to 40 percentage. So that's one of the strategy where you can minimize your tax. This will also help you contribute to Roth IRA for your family member or your children at an early age, assuming they contribute around 7,000 each for next 4 to 5 years, which is around 35,000 in a 4 to 5 year period. At the age of 12 years or maybe at the age of 15 years, for the retirement, we are looking at, easily more than half a million, or it can go up to 1 million in total if they start Roth IRA contribution early at this age. And in general, as you know, that the qualified distribution from Roth IRA is tax free. So that means, the portfolio which has grown up to half a million or 1 million is completely tax free for them. Now, you can also take reimbursement for home office deduction, assuming your office address is your house, you're operating, and you have a dedicated office space, which is basically one particular room or a area which is dedicated for office purposes. Then you can take reimbursement for some of your expenses, which includes your mortgage, property taxes, utilities, electricity, internet, these kind of expenses. So based on the square feet area used for business versus overall square feet area of the property, you can take a reimbursement for your business from your business. And then also we suggest, if you have an LLC, we suggest you to maybe elect it as an S corporation for tax purposes. In general, if you have an LLC, the net profit after taking all the deduction becomes a salary income. That means you pay income taxes, social security, and Medicare tax. Now, if you are at an income of 3 to 400,000, your income tax bracket is around 30 percentage, 28 to 30 percentage. Then in addition to that, you have to pay 14 percentage social security and Medicare tax. But with an S corporation, you can avoid paying social security and Medicare tax on the profits, whereas you pay social security, Medicare only on the portion of your business income that you take it as a salary, as a reasonable compensation. So that's one of the strategy where you can minimize your taxes. Also, if you are looking to start a business, roll over as a business startup, or using your 401k, you can set up your business, which is called as ROPS. So if you need more information, definitely we can help you with that. Please do contact us. And then if you see the simulation, now as somebody earning, a business owner earning around 800,000 in gross income, assuming they take tax deduction for the solo 401k contribution around 70,000, and then a defined benefit plan or a pension plan contribution around 200,000, Then also take bonus depreciation or a vehicle deduction of around 100,000 or any other asset they may have in the business. Also a salary to a family member around 20,000, reimbursement for house expenses, which is home office deduction around 15,000, and then also you take qualified business income exemption or a deduction around 30,000 of estimate. We are looking at reducing your income from 800,000 to 365K. That means your tax saving is roughly around 160 to 175K. So that's a huge number. Now, these are some of the important filings, especially as most of us, we have some foreign connect, meaning we have accounts or the transactions to foreign countries, maybe to transaction to foreign country or transactions to India. So most of us, we may have some of these filing requirement, especially if you receive a property or a cash as a gift or inheritance from parents and relatives, which is more than 100,000 in value. Then you need to file a form 3520. If you have received this in 2025, you need to file a form 3520 by April 15th. This is a separate filing, not filed with your tax return, but I say, if you are subject to any of these filing, I strongly recommend that you don't miss filing this, because the penalties are huge. These are compliance filing, but the penalty starts from around 10,000 for each filing. Now, if you have F-bar filing requirement, if you have foreign financial accounts, which includes the bank account, fixed deposits, your insurance account, your brokerage account, any financial accounts outside of the US, and the highest aggregate balance was more than 10,000 if you have accounts in India, and the highest aggregate balance was more than 9 lakh rupees, then you have to file F-bar, which is FinCEN 114. This is filed separately. And then also, if your highest aggregate balance, in generally people who sell property, because I see these days many people, they sell properties and repatriate the money. There could be a lump sum deposits into your foreign NRO NRE accounts. Now, if the highest aggregate balance was more than 150,000 at any point of time, or more than 100,000 as on 31st December, there is a filing called FATCA, which is Form 8938. This is filed with your tax return, and the due date is April 15th. Now, if you have any income from foreign accounts like interest income, dividend income, or if you have redeemed your life insurance policy, there could be some bonus income. So these are all subject to taxes. You will have to report in your report on your personal tax return. But any taxes you paid in India can be taken as a credit because of the tax treaty, but the disclosure is required. Now, if you are an investor or a shareholder in a foreign company, maybe a private limited company or an LLP outside of the US in India, so you may be subject to a filing called 5471. Now, if the shareholding percentage is more than 10%, this is one of the important filing. If your shareholding is more than 50%, then it becomes a controlled foreign corporation. The disclosure and the taxation is much complex. So you will have to work with your accountant to make sure that you're filing this form, because the default penalty for filing this form late or not filing this form is minimum of 10,000. This is about sale of property, and as I get to see many of my clients, they want to sell properties, repatriate the money, invest in US, or maybe buy a primary house, different reasons, or they have received a property or property as a inheritance or a gift from parents. So this is the tax impact. I thought I share this information with you on the tax impact of selling a property which is in your name. So especially when you sell a property outside of the US, in India, so the tax rate is around 20% with indexation. It is around 12.5% if you are not taking the indexation. So it is optional. You can either do with indexation or without indexation, whichever is beneficial. Now, when you work with your chartered accountant, he can help you understand, okay, which method is beneficial, so you can follow one of them. And then also there are some opportunities in India where you can reinvest and minimize your taxes. That includes reinvestment in maybe buying another property, reinvesting in a capital gain account, savings account, or investing in a National Highway Authority bond. So these are some of the ways where you can minimize your taxes in India. But the problem is this will be recognized only in India. That means you can take tax exemption or you can defer your taxes only in India. But the US IRS will not recognize the foreign reinvestment or exemption. So you may still end up paying taxes in US. You have to be careful when you reinvest in India. It is limited to your tax, tax reduction only in India. Also, once the tax computation is done and you have paid the advance taxes, now you can, your accountant can help you file a repatriation form, which is called as 15CA and CB certification. This will help you repatriate your money. This is what your bank manager may ask for in most cases. So basically, you'll have to submit this 15CA and CB certification, where your manager can wire the money directly to your US account. Now, in the US, you will have to do the parallel computation. In US, depending on your tax bracket, now if your income, if you're filing jointly, and assuming it is a long-term capital gain, if your income is less than 100,000, generally for a long-term capital gain, there is no tax. But if your income is between 100,000 and 600,000, you may be at 15 to 18 percentage tax bracket. Anything more than 600,000, you may be at 20 percentage tax bracket for a long-term capital gain. And then also depending on your state, it can be in the range of 5 to 10 percentage. So basically, you will parallelly compute the tax return. You can take the conversion benefit. If you have invested maybe 5 to 10 years back, you can take the same conversion rate for your purchase price. So the tax computation and the capital gain in India could be different from the computation in India, but in general, because of the conversion benefit and the indexation in India, uh, could be approximately the same. So the tax paid in India, you can take a credit. That means you are not paying the double taxes, but some of these states, they don't recognize a credit for the tax you pay in foreign countries. So that means you may end up paying tax for the state. So we are looking at approximately for a long-term capital gain for a property sale in India. We are looking at least 25 percentage, 20 to 25 percentage overall on your capital gain. And then you need to file a form 1116. This is the form you file to take a credit for the tax you paid in India. And there are some planning opportunities, which is investment in a qualified opportunity zone fund, where you can minimize your taxes, but you will have to assess how much to be invested in India, reinvested in India. That will give you an exemption or where you can defer. Also, how much to be reinvested in India, in US, that will help you minimize your taxes. But if you are expecting any properties as a gift from your parents and relatives, what we suggest is, if your objective is to sell that property and repatriate the money, the best option is they sell the property and give you the cash so that you don't get into tax implication whenever you receive a money as a gift. You just have to file the form 3520 if you have received more than 100,000, so you don't get into all these complications in the US and India and various reporting and then the state taxes. So that's our suggestion, and when you're expecting anything from your parents and relatives. And that's all from my side. Thank you so much for joining. This is my contact information in case if you need more information on what we discussed today. Or, as you know, the tax planning can be different for each person depending on your circumstances, income, and then your basically objective. The planning for people who are getting started is different. Planning for people who are moving out, it may be a good idea to roll over your money from traditional to Roth. If you have money in the retirement accounts, or it may be a good idea to withdraw to a certain extent. So we can provide you all kinds of one-to-one tax planning. If you need any consultation, please feel free to reach out to us, and we can help you with that. That's it from my side, and thank you for joining us. And if you have any questions, we can take right now.
Yeah. Thank
Yeah,
you,
I think.
Prasanna.
Oh, sorry. I think now we're going to move to the Q&A portion. So thank you, Prasanna. That was very informative. I believe somebody has already asked, Manikandan sir has asked, what is SALT tax savings? But if anyone else has any questions, please feel free to put them in the chat. If anyone wants to unmute and ask, I think that's fine too.
Yeah. You can add a thumbs up, then, like we can unmute yourself, then you can ask directly the questions to Prasanna. Yeah.
Yeah. So thank you, Mr. Manikandan. So I think your question is on What is SALT deduction? SALT deduction is the deduction for the state income tax you pay on your earnings, which is mostly on the W2 you may have paid some state taxes. And then also if you own a house, you pay property taxes on yearly basis. So earlier the state income tax and the property taxes together, there was a limit of only 10,000 with the previous tax law with a one big beautiful bill. It has been revised to 40,000 now. So that means, if your overall income, family income is less than half a million, you can take up to 40,000 as a SALT deduction, as an itemized deduction when you file your tax return. So you'll have to make sure that you're filing Schedule A and taking those deductions. Thank you.
Prasanna, I have one question. Like, is full-time employees, can they, if they are working from remote, can they use that for tax filing? Like, they are full-time employees, but they all work from remote locations, right? Or is
Meaning
it only if you have companies?
if they're full-time employees operating remotely, can they take house-related expenses? Is
Yes,
your question?
house-related expenses and everything.
No, earlier there used to be some unreimbursed job-related expenses which has been eliminated now, meaning there is no deduction for that these days. It's been long time. There is no deduction. Only if somebody is working as a consultant on a 1099 as a 1099 contractor, then they can take deduction for the home office expense, but not as a W2 employee.
Okay. Thank you. Thank you.
There is one question from Mr. Ashraf. It says that can I defer my capital gain profits from 2025 to 2026? Yeah, the qualified opportunity zone investment is one of the option where you can defer your tax, or maybe you can use the tax loss harvesting. That's another option depending on the profits you. I would suggest you please consult with us, contact us offline. We'll try to understand the amount of capital gain, and we can try to see if we can minimize that or defer to next year. Then does employer PF account come under FBAR? Yes, all the financial accounts has to be reported, including the provident fund, which includes the employer provident fund has to be reported on FBAR.
That makes a great question, Preeti. Thank you. Actually, like, so what if I don't know, right? Like exactly like how much I have it in India, right? Maybe like you might have invested in many places, right? Can we give a tentative amount, or is it
It'll
needs
be
to be
okay
very
to
accurate?
report an approximate amount if we don't have access to the statement or the information,
Thanks.
because it's more of a disclosure. They want to know, okay, what kind of accounts and how much balances we have. So it's okay to report in a approximate amount for only the accounts which we don't have the information.
Okay. One of
Especially for life insurance, it says that we have to report the surrender value. Now we don't know what is the surrender value. Maybe it's a good idea just to report the cumulative premiums we paid so far, maybe from last 5 to 10 years. So if we are able to get that information, surrender value, yes. If that information is not available, then we suggest you report on your contributions.
One of the question from they pinged me separately. They asked like one time if you report the F bar, so are you forced to report all the years, all the future years? And if they, for example, if they have some fixed deposits and if they have removed it, or they have used it for some expenses, still are we forced to report the F bar till their lifetime? That's the question they
No, it's not mandatory. It is only in the year it exceeds more than 9 lakh rupees,
Okay.
which is $10,000. There is no connectivity, because I've seen many people who have crores of rupees, they file 1 year, not file next year. So it is only applicable in the year there is an highest balance. And most people, when they sell property, they immediately repatriate money to US. So there is no balance. Some people, they may even close the account. So it's not mandatory. As long as it is just a disclosure. As long as we have declared everything, even if there is a question for the year, it's not applicable, does not matter, because I don't see any cases where because of the inconsistency, IRS or the Treasury Department contacting that, you're not filed FBAR. We don't see anything so far. Yeah, so no problem with that.
Okay. There is another question in the chat. It's from Jana. What if we never filed F bar for last 10 to 15 years? can we still go ahead and do now? And will it incur penalty?
Good question it is. So there is something called voluntary disclosure program or a streamlined filing program. So IRS knows that many people are not aware, maybe they're self-filing, or most some of the consultants, they are not aware that there is something like FBAR is required. So they know that, so they have come up with a voluntary disclosure program. What it says that if you are missed filing the FBAR and it is unintentional, not a willful violation, they say that you can participate in this program and file your FBAR for the last 6 years, and then file the tax return, amend your tax return. In general, if you have money in the bank accounts, there could be some interest income, some dividend, or some income received. So amend your tax return for the previous 3 years. And then there is some penalty for one of the year, whichever is highest based on the balances out of last 6 years, whichever is highest balance in your bank account. There is a 5% penalty for not filing, one-time penalty. So by paying this penalty and taking care of it for the last 6 years, you are completely compliant with all the things once it is approved. So it's a complex process. You need to closely work with the accountant to see if you whether you are eligible for this program.
Yeah. If anyone else has any questions, if not, right, Roshan, we can do a thank you note. And
Yeah.
and
Hi, I have a question, quick question.
yeah, sure.
Yeah, thanks for the session. What is the service fee for the individuals having W2 and then having E-Trade gain and loss?
Generally, there are one or two W2s and some interest income, one or
Mm.
two brokerage accounts for the capital gain, maybe stock trading. And then if you have a primary house for the primary house deduction, we are looking at approximately around 300 could be the filing cost. So
Okay.
there is a huge gap in pricing for a simple return versus a complex return, because we do see some of the clients, they have more than 30, 40 or 50 documents. So it's completely based on the forms and complexity. What we do is generally in our office, we have a pricing checklist. We take all the information, like what kind of filings are required, and then give a quote. If you can upload the document, we have a secure portal.
Okay.
And if you can upload the document, we give a price quote in advance. Once it is approved, we start filing the tax return.
Okay. If I do it with TurboTax, right?
Hmm.
So currently, as per the TurboTax, it's like $150.
Yeah.
So I'm sure that you guys will do more work than TurboTax software. So what do I gain from your service than TurboTax?
So to give you an example, let's say in your case, our price is 350 and TurboTax is charging 150.
Yeah.
What we suggest is, does not matter whether it is me or company. So I would still suggest, if you are, if you are able to, I don't say afford, but if your earnings is 200,000-300,000, half a million, or you are getting into various other investment, you need somebody who can advise you. So that's how we take client where we can add value. So we are available 365 days. We are just into this. We are a team of around 40 people. We are full time into this tax, accounting, bookkeeping. So at this moment, it could be a filing service. We do assess and see if you have missed out any deductions like HSA, IRA, small amount, you may save something there. But in long term, we can also provide maybe 10 to 15 minutes consultation, or if you have any questions throughout the year. So that
Okay.
200 extra you pay is definitely worth paying, because you are somebody, definitely having some accountant is very important for
Okay.
you to take a right decision, especially if you're diversifying your investments.
Just to add to Prasanna, Rashid,
Yeah.
he's from San Francisco Bay Area. I live in the Bay Area for last 20 years. So he's there for a long time. He's the biggest supporter for our Bay Area Tamil Mandram and FeTNA and everything.
Okay.
Even though he is he mainly speaks Telugu, but he understands Tamil and everything.
Okay.
But he is still, voluntarily donates for many of these organizations across Bay Area. So we know him at least for last 20 years. So So, you
So
know, he's
also,
always
most
reachable.
people, to give an example, some
Yeah.
people they do a computation because maybe
Yeah.
they like to do it, TurboTax, but they still file with us because they don't want to file it as self-filed tax return. They need somebody who can, they want somebody like professional to file on their behalf. So we have different kinds of people, it's all based on objective, and how you can use us is also more important. If it is simple filing, I would suggest, just W2, or maybe it is a good idea to file online. We may not be the right people.
So one thing, right, Rashid? So that's I have noticed for a few of our friends, right? So as long as you have no problem, no issues. If you get into any trouble or any audit, right, that's where the problem comes, right? We don't get the proper support.
Okay.
So we
That's
discuss
where we
some
really need an
foreign
audit.
compliances and all, right? These are
Yeah.
simple filings, okay. But then, it will be very stressful because I've seen they may realize this, attending maybe some session, it will be too late by that time, okay.
Okay.
So these are some of the things, advantages working with professionals, so that, you don't do any mistakes and get into problems with IRS.
Okay. I need some help with the last year's filing. I need someone to review and see if any correction can be done. I will reach out to you,
Yeah,
and then
sure. Last year's meaning 25 or 24?
24.
24.
Okay.
You do, please contact us after April 15th, so that, we can
Okay.
spend good amount of time, because you have 3 years of time to file any corrections. This is a very
Okay.
busy time, so we want to
Okay.
make sure that we are giving a good service to you. So
Okay.
if you can contact after April 15th, we make sure that, we try to spend some time and give you that.
Sounds good. Yeah.
Yeah.
Thank you.
And Ram has one question, Prasanna. With higher mortgage rates, Roshan, you want us?
Yeah, I'm happy to. Give me 1 second.
Mm.
Yeah, with higher mortgage rates, is going with the itemized deduction better than the standard deduction? I think that's what Ram's asking.
100%, especially with this SALT deduction, right? Especially if somebody is earning around 300,000, state taxes, they may have paid at least around 15-20,000, right? Even if it is 5%, we are looking at 15,000. And then you may have paid some property taxes, let's say around 10,000, we are looking at least 25,000 in property tax, state tax, and then some mortgage. So overall, your itemized deduction could be in the range of 40 to 50,000 or more than 30,000. So your standard deduction is only around 30,000, right? So if your itemized deduction, in most cases, if you own a house, so it will be beneficial to take an itemized deduction. So whichever is beneficial, so depending on the mortgage interest and the property tax and state taxes.
Awesome. And then we have one question from Mr. Gopal. He's asking if FeTNA tax helps in setting up private family foundations as well.
Thank you, Mr. Gopal. Yeah, certainly we can help you with set up the private foundations from our office. We can.
So we can reach out from Tax, the website, right? And we can.
Yeah.
So is it something we have to do it before April 15th, or it can be done anytime like this?
This will be for 2026, so we have time till end of the year. But generally, the private foundation setup may take at least a couple of weeks, maybe 2 to 3 weeks. So maybe, November is the best time, or we can get started right now. But for 2025, it is too late to set up a private foundation and take donation deduction. So it will be for 2026.
Okay. Thank you.
Hey, Prasanna, I had a quick question. So I know you're based in California, but are you servicing all of the US, or how does that work?
Yeah. So we can provide as an IRS enrolled agent, enrolled to practice with IRS. We do practice all the states. We do have clients outside of California. We do have many clients in North Carolina. We have clients in Texas. So we operate all states, so we can help with any state.
Thanks.
And one more question from Sendel. Does selling property in India result in taxation both in India and in the US?
Thank you, Mr. Senthil. Yes, there will be a reporting if the property is in your name, the title is in your name. There is a disclosure both in US and India, but the tax you paid in India can be taken as a credit. So because of the tax treaty between US and India, there is no double taxation, but depending on your state of residence, there could be additional tax for state. So we are looking at if you're if somebody is earning around 300,000 in income, and they have a capital gain of maybe 100,000 from sale of India property, we are looking at tax of approximately around 25%, both in India and US together. That would be the tax impact.
Thank you so much, Prasanna. I know it's extremely busy time for you, especially this tax filing in the last moment, right? So, and if anyone wants to reach out to, right, so they can always go to the FinLoTax website, and there is something called schedule session, and they have a call option through which you can always reach out to them. And right, it's across US, anybody, right? So anytime they want any help, and he is here always to help us. So.
Okay, thank you so much, Karthik, FeTNA,
Yeah.
and Roshan, Pradeep, and everyone. Thank you so much for everybody who have joined. I hope this was helpful. If you have any further question, please do contact. We can help you with that.
Roshan, you want to do your closing note? And
Yeah. Thank you everyone for joining. I hope everyone took away a lot of stuff. I know personally I'm very lost in the world of taxes, but this was a very great insight on what the future could look like. So I hope everyone took away a lot of things. Thank you, Prasanna, for sharing and taking your time out of your day. I'm sure, as Karthik mentioned, it's very busy. So we really appreciate it. And Pradeep sir, also thank you for hosting and running everything in the background. Karthik, thank you for having us. Yeah, I hope everyone had a great time. We will see
Thank
you
you.
soon. Good luck with
and
your
also, we also have it in YouTube and Facebook, right? If you want to watch anytime, feel free to go and watch it, and you can always reach out to FinLoTax. His name is Prasanna. So they have around 40 consultants. So it's they will be available to do that quick 15 to 20 minute session, and you can make a decision from there. Thank you all.
Thank
Thank
you.
you.
Bye.
You all.